Hello investors, welcome to Proceemo, the Value Stock Analyzer. Today is November 28th, 2022. I hope you all got your booster vaccines for that extra 5G reception because today we're covering Verizon. Can you hear me now? More like, can you pay me now? Are Verizon's financials as good as its cell phone coverage? Stay tuned to the end of the video to find out. Don't forget to like and subscribe. Your support will help us continue making content for you. And please check out Proceemo.com to check out this analysis for yourself. Last week, we talked about recession stocks when we covered McDonald's. We defined a good recession stock as having all of the following three key attributes: an essential good or service, not middle-tiered, experience weathering the storm of previous recessions or downturns. Verizon arguably checks all three of these boxes. First, Verizon is in the business of communication, phones, internet. Maybe not as essential as food, but certainly an essential in the 21st century. Second, Verizon is a top-tier cell phone service provider. There's not many tiers of the cell phone providers, but I think most of us would agree if there was a high-end, aka the most expensive service, Verizon fits the bill. And finally, experience to weather the storm. Verizon weathered both the Great Recession and the dot-com bubble, but Verizon by name has only been around since the year 2000. While they have only been around since 2000 technically, Verizon has a far more nuanced history. Verizon was actually an offshoot of the Bell system, specifically Bell Atlantic, which dates back to 1984. Before that, the Bell system was, by a huge margin, the largest provider of telephone service in America for over 100 years, dating back to 1877. In 1983, the Bell system was broken up for antitrust violations, and instead of one major telephone provider in the US, Bell was broken up into 7 providers, one of which was Bell Atlantic based out of Philadelphia. In 1997, Bell Atlantic merged with another of the 7, NYNEX. They also acquired GTE Corporation, the largest independent telephone provider in the US, and became Verizon in the year 2000. All that to say, Verizon weathered the Great Recession and the dot-com bubble in its current form, but has its roots back to the late 1800s and has fared pretty well all things considered. Verizon, by our recession criteria, checks all the boxes. Verizon's business is not just wireless phones and home internet either. Verizon does quite a bit for other enterprises in the way of being an internet service provider, digital security services, and they act as a managed service provider for small and medium-sized businesses. This means that if you are a small business looking for help in building your IT department without having to staff a team, you can outsource this entire process to Verizon. Verizon truly has a lot to offer. Let's see if the financials offer us a reason to buy its stock. Verizon is currently trading at $39.02, which gives it a price to earnings of 7.84 and a market capitalization of $163 billion. Verizon 1 year ago was trading over $50 and peaked in April at $55 before coming down throughout the year. Year over year, we are down 22%, down as much as 28% about a month ago. Our implied growth is less than 1%. Implied growth is a calculation that tells us how much growth is baked into a stock based on its earnings today. Implied growth is not a crystal ball, it is merely a measure of the current stock price compared to previous earnings. Like we say all the time, past performance does not tell us future results. Implied growth at 0.91% is pretty low. That means at the current price levels, we don't expect much growth out of Verizon. There's a good reason for this low level of implied growth, and that is the dividend. Verizon is currently paying a dividend of 65 cents, and we will cover that in just a few minutes. Looking at revenue growth, Verizon is fairly steady really. The 10-year average being 1.93%, 5-year at 1.22%, and 3-year at 0.74%. That's actually pretty close to our implied growth. For a big established company like Verizon, we actually care more about earnings, similar to McDonald's last week. Earnings tells us an interesting story. Over the past 5 years, we've had earnings as high as $30 billion and as low as $15 billion the following year, 2017 to 2018. The fiscal year ending last December 2021, Verizon had earnings of $22 billion. Since we are very close to the end of this fiscal year, we can look at our quarterly data to see where Verizon might come in this year simply based on trends. And it looks like Verizon might struggle to break $20 billion in earnings this year unless they can make big cost improvements in Q4. Verizon earnings are spiky. Also, not terribly surprising. Verizon has to constantly invest in technology to keep up with competition, which means some years will be better than others depending on their investments. With inflation and interest rates on the rise this year, it's no surprise we'll see a drop in earnings, which certainly accounts for the drop in stock price. Because of the extreme peaks and valleys here, Verizon's average earnings growth is 10.16%, 24.26%, and 13.47% for 10, 5, and 3-year averages respectively. On to key metrics. Enterprise value comes in strong at $394 billion, and if you recall, our market cap is only $163 billion. That's a pretty big difference and suggests there is a lot more value in Verizon than the street is giving it credit for right now at this current price. Before we go to our scorecard, let's check out institutional ownership. For a lot of stocks, we've seen pretty big drops in institutional ownership this year as stock prices fall and interest rates rise. However, Verizon ownership has dropped very little. This tells us that, like us, professional institutions also think Verizon is a strong recession stock worth holding onto right now. Now the scorecard. Implied growth over 5-year average earnings is coming in low at 0.04. A value of 1 would indicate a fairly priced stock, less than 1 would mean a deal, over 1 would mean the stock is overpriced. 0.04 is crazy low, but that's also because of the very spiky earnings we saw earlier. I'm not reading Verizon as this much underpriced at the moment, so we'll just leave this where it is. Liabilities over assets is a little high at 0.77. We say a range of 0.3 to 0.6 is healthy. Verizon is a little over leveraged by that measure, but not much. And like we said, Verizon constantly needs to invest in technology and infrastructure to keep up with the competition, so we are pretty comfortable at 0.77. Steady dividend is true. Let's take a look. 10 quarters ago, the dividend was at 62 cents per share, and now it's at 65 cents. That's a 5% jump in 2.5 years, which is great to see. Also, 65 cents at $39 a share is a 6% yield, which is really great in our opinion. Our dividend ratio is also mostly healthy at 3.79. Usually we would like to see this over 4. 3.79 is close. We don't really get worried until this falls to less than 2. Our market cap to revenue ratio is 1.23. Revenue last year was $133 billion. Market cap is $163 billion. Verizon has pretty thin margins, and for competitive industries, this is what we would expect. 5 years of increasing revenue is false. 120% of assets greater than market cap is true. That's a great sign that there's a lot of value in this company that's still not reflected in the stock price. 3-year average revenue growth greater than 10 years is false. This is not something that surprises us. Increasing revenue growth is also false, also not a surprise. 5 years of assets greater than 150% of liabilities is false. New to the scorecard is market capitalization to enterprise value ratio. A value of 1 here would tell us the stock is fairly priced. Over 1 would mean the stock is overvalued, and less than 1 would be that the stock is undervalued and underpriced. 0.42 is well under 1. As we noted earlier, the enterprise value of Verizon is well above the market cap right now. So this is a really interesting metric for us. Finally, revenue per employee coming in at $1.1 million. This feels high, but again, it's a thin margin business. Compared to AT&T, it's only a little bit higher, where AT&T comes in at $1 million per employee. And again, this is more of an interesting stat than a telltale stat for us in our value analysis process. Overall, I think Verizon is a great recession stock right now, and I think it's priced really well. It's priced really well for the dividend coming in at 6%, There is a lot of intrinsic value in Verizon based on their assets alone, and the enterprise value is well over where the company is priced right now. I wouldn't expect to see massive growth over the next 3 to 5 years, but even if it returns to its highs from the last year and pays that fat dividend, that's a great win right now. That would be 20% growth plus a 6% yield each year that you hold the stock. That's it for today. Please like and subscribe if you found this helpful. And if you really want to support the channel, please go to Proceemo.com and subscribe to our monthly service to see analysis like this for yourself for only $5 a month. And if you have stock you'd like to see featured, please comment below. Thank you. Happy investing. Go find some value.